Welcome to This Week in Money. I'm Phil Mackesy. Today, David Morgan on a great week for gold and silver. Louis James talks gold miners, and Robert Campbell has a U.S. real estate update. We begin with David Morgan right after this.
American Manganese Inc. has a manganese deposit in Arizona, indicated 6.7 billion pounds, inferred 8.9 billion pounds, potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
It's all about money. At the HoweStreet.com Money Expo, they'll be talking money, making money, saving money, and protecting assets. See Ross Clark with technical analysis, Louis James on metals and mining, David Smith on junior markets and more. Plus, visit with industry exhibitors. The HoweStreet.com Money Expo in Victoria at the Conference Center, Saturday, June 16th. To attend free, pre-register now at moneyexpo.ca. That's moneyexpo.ca. It's all about money.
Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
David Morgan is our guest. He's an expert on the silver market. You can find him at silver-investor.com, home of the Morgan Report. Hey, David, it's good to have you back.
Phil, it's great to be with you.
You were at the World Resource Investment Conference here in Vancouver Sunday and Monday. Sunday, you're talking about where are we in the precious metals cycle, and Monday, silver and the China factor. Give us just a quick thumbnail sketch, a sneak preview of what you're talking about.
We've had a good 10 years in the bull market, maybe longer than that. I mean, the bull market in gold started roughly in 2000, and so that's 12 years. And silver actually didn't start its bull market until slightly later, probably around the 2003 time frame. But regardless how you measure it, people want to know, is it over? Because the mainstream financial press has really done a pretty good campaign. Once gold got above 1,000, there was a big campaign that gold's in a bubble. And then they kind of backed off of that. And then once it hit up above the 1,500 level, moving into the 1,900 region, they came out again with the bubble theory. Well, since gold did hit the 1,900 level and has backed off to about the $1,600 level, and it's taken, several months. In other words, that peaked in September. So now here we are looking in June. Hasn't been a year for gold, 9 months or so. Some people are questioning their beliefs. Is the bull market over? Was that the peak? And the same thing with silver. Silver peaked earlier, peaked about a little more than a year ago, peaked at the end of April 2011 at $48 and change. And here we are today at $28. So a $20 move to the downside, quite significant in anybody's book. So the question has arisen, was it over, and where are we? Well, where we are is very similar to where we were in the previous bull market. When gold was freely trading after Nixon closed the gold window in the early 70s, gold went from the price that was an edict by government of $42.22 all the way up to almost $200. And everyone was pretty euphoric, especially the gold bugs. And then it backed up and went all the way down. So it went, from 42 really up to 200. So you got about 500% increase. Then it went down to roughly $100. And a lot of people thought that the bull market was over and that the gold had overdone itself, and there was a lot of negative talk about gold. And then from that bottom, it went up eightfold. It went from the roughly $100 level up to about $850. So it was really a significant move, but people, that got out, and people that got in, and there was, of course, a massive move near the end. The last few months in the gold trade was just, very much of a classic mania move where there were just huge moves. We had gold open in December around the $300 level, so if you were just in December and January, you could have tripled your money pretty easily in the gold market. So that's how these markets move. I'm just here to assure everybody that, it's not over. It may not be as quickly or as energetically as you like, but once it starts to move, you want to hold on because these moves can be quite dramatic, quite breathtaking. And I believe that this time the end game or the final significant thrust in the metals markets, both gold and silver, will be going in the record books, because this time around it's not going to be a bunch of a very small percentage of Americans that are worried about the U.S. dollar. It's going to be a global move based on the U.S. dollar or any currency, euro or any fiat currency, roughly, that they want out of it into gold. So it's going to be a significant move in my view.
We're talking to David Morgan on This Week in Money, and after a so-so week, we had a great day for gold and silver today, mostly on the back of that lousy U.S. jobs data, also the debt crisis in Europe and the Chinese economy playing into it. Gold zooming past $1,600 an ounce this morning.
Well, we've definitely seen one heck of a day here, and it continues as we're doing your show. It's gold's up almost 4%, silver's up well over 3%. Silver's up almost $1. Again, as you said, the jobs numbers, the euro crisis, on and on. Wouldn't surprise me to learn after the fact that maybe Japan or China or somebody's been selling the U.S. bond. The bond market is very, very overbought in my view. I mean, you're buying paper that's dated, 10 to 30 years out, and to think that paper will have the value that's printed on it 30 years from now is definitely a pipe dream. It's not going to be there. So there's lots going on in the financial markets. Gold and silver reflecting that. Coming back to the original question, the other lectures about silver and the China factor, and China has really done a U-turn over the last 10 years. They went from being a net exporter of about 100 million ounces of silver a year to a net importer of 100 million ounces of silver a year. That's been over the last 10 years. So that's a swing of 200 million ounces. And they are catching up to the West rapidly in the technological area. So anything that's using electricity or any electronic platform like a cell phone, laptop, solar TV, flat screen TV, anything like that, solar panel, uses silver. And so China is slowing down, but the momentum is still there. I think it's going to continue to increase their silver usage, and they could curtail their silver usage on the upswing if they were to have a very long recessionary time frame. But there's so much momentum built in the system and manufacturing, and they're really not slowing down in most of the uses of silver. So I think it's going to still be a big market for silver in the future, and I do believe it'll continue, probably not as rapidly as it might have the last couple of years, but still the trend is still up.
David, all the numbers we're seeing today and the last week or so pointing to a global economic slowdown, and of course the talking heads are calling for quantitative easing this summer. What do you see happening?
Well, I see that they have no other choice, unfortunately. The real thing to do is to stop all this printing and to let the markets clear themselves and find the right prices for exchanges to take place. But that's not going to happen in my very strong view, and there's very few that disagree with me, although there are a few that will. And so what's going to happen is, whether they call it QE3 or not, is this will put a fire under real assets again, particularly commodities, and of course the top tier of the commodities are the gold and silver market. So I think it's going to be a very interesting remainder of the year. I'm still looking for silver to be above 40, gold to be back to the old high of 1,900 to 2,000 by the end of the year, and it could overshoot that. We'll just have to wait and see.
How about physical demand? Getting the reports here from the U.S. Mint. American Eagle gold coin sales fell by more than half in May, but those were still double those of April.
Exactly. As all markets, it ebbs and flows. The physical demand for silver and gold has been increasing, generally speaking. Now, when the prices fall off like they have recently, the demand, although you would want it to go, expect it to go up because prices are low and you should be buying low and not high, that's not what really takes place. What really takes place is people get excited when the price is moving up, and they tend to buy more at that time. So normal market activity, but again, as you pointed out, the trend is, if you go back a few years, you'll see even though it was a low compared on a month-over-month basis, if you look at it on a year-over-year basis, it's actually increasing. And that's my point about the China and silver market, is that, it might be slowing relative to their peak months, but if you look at it relative to a few years back, the trend is still significantly higher. We're talking to David Morgan on This Week in Money, and a great day for bullion ETFs and mining ETFs as well. The bullion ETFs up around 3%. The GDX and GDXJ both up over 6%. Well, I've been calling a bottom here for the mining equities for a little while, and it's been very recent, and it's always tough to call bottom or top. I find it a little more difficult to call bottoms than tops. But basis the GDX, it looked to me like it was done. In other words, the bottom was in. And, of course, the sentiment was so low, and people have been beaten up in these stocks so much. And, it's like, oh, I've heard that before. And not from me, but they've heard it from others. I mean, lots of people were saying, we're going to explode to the upside.
Mm-hmm.
And that was, month after month after month. And, of course, we just kept going lower and lower and lower. Point being is when I saw what I wanted to see was a capitulation. In other words, huge volume on a very big low. And that's what we saw. And the reason for that is the professionals are short this market, and they know when to get out for the most part. And when you have massive volume and the price stays low, normally that's short covering, and I'm almost certain that's what it was. So that clears the market. Once the shorts are out and they've taken their profits because of GDX or these mining companies have gone down significantly from where they placed their bets that they would go down, that's pretty much the end of it. And that's what I saw, and that's my call, and I'm sticking with it.
Now, we should mention in the interest of balance that the GDX is still down 10% year-to-date, and the GDXJ still down 17% year-to-date. So there's still a fair bit of upside for both of these things. Yeah,
there is. I mean, I could be wrong. I can always say that, and it's always true. But but again, based on the data and the technicals, I think the worst is in. And to be safe, if this isn't the exact bottom, which again is very difficult to forecast or call at real time after the fact, is pretty easy. Just start getting back in here if you've gotten out and have some money on the sidelines. If you're new to the market or you want to reestablish a position or whatever, do it over the next few months. Normally, the best month to buy gold is August, and mining companies is best in the summer, and we really aren't in the summer yet. We're still in the spring. But I don't think the seasonalities are holding this year. Last year, we were really strong in the August time frame, not weak. September was the weak month. So these things don't always hold. They generally are just trends. I think the trend this year is you're going to bottom earlier in the year, meaning like June, not in August.
Okay.
And I think we're coming up, not down.
So what's your advice for people who are accumulating? Should we be patient, wait till August, or should we start hammering away all summer long?
I think depending on your perspective.
Okay.
If you are a long-term investor, then I would say get in over the next 6 months or so and just average in. If you are more aggressive than that or you tend to trade, I'd say you should get in over the next 2 to 3 months at the most.
Anything in the near-term horizon that could turn things around, David?
No, I mean, there's so much going on in these markets. As my friend in London, Ned Dealer Leyland, says, who manages a hedge fund, there's so many black swans flying around, it's really hard to know when one's going to hit another one. I would just stay cautious. I would not use margin. I wouldn't use any leverage unless you really know what you're doing. Or if you are using leverage, use something like an option that your defined loss ahead of time. And don't get too greedy here. Let the market come back and really let it prove itself. I mean, if you're conservative, you don't have to get in, immediately, as I keep saying. You want to go ahead and get in as the market progresses either direction. But I think this is a good opportunity here for the rest of the year that we'll see these markets perform well. Wondering whether it's time to short gold. Here's a triple inverse ETF, the Direction Daily Gold Miners Bear 3X shares. The symbol is DUST, which is kind of funny, dust. Unfortunately, that is down 19% today. Good time to get in there? Yeah, well, I'm not too favorable to shorting gold. We do write covered calls on some of our positions from time to time when I think the market's overheated. I wouldn't want to be excuse me, I would not want to be short gold today, and I certainly wouldn't want to be short gold really over the next several months. I think, again, we're pretty close to the bottom, if not at the bottom. And with all this going on, the metals are going to start to shine again. You can see David Morgan at the World Resource Investment Conference here in Vancouver, Sunday and Monday. You can register free at CambridgeHouse.com. And don't forget, you can find David at silver-investor.com, home of the Morgan Report. David's latest thoughts on his blog at the blog silverinvestor.com/blog. And on Twitter, SilverGuru22, and on YouTube at SilverGuru. I guess I covered the whole works there, didn't I, Dave? Well, you got it all, Phil. Thank you so much. Hey, we look forward to seeing you probably Sunday or Monday at the investment conference. Very good. Thank you so much.
Coming up, Louis James on This Week in Money.
Always consult your investment professional before making any investment decision.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com, or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
Louis James is Chief Metals and Mining Strategist, and he's Senior Editor of the International Speculator and Casey Investment Alert. He is online at caseyresearch.com. Louis, it's great to have you back on This Week in Money.
I'm glad to be here.
You are at the World Resource Investment Conference here in Vancouver. Hopefully we're going to have some nice weather for you Sunday and Monday, June 3rd and 4th. Monday afternoon at 4, you're talking about Contrarianism 101, falling safes and other killer opportunities. How about a quick sneak preview of what you're going to be talking about?
The idea is very simple, and a lot of people think of themselves as contrarian investors, but the reality is that few people can actually do this, and this is why you can make money doing it. If it was easy, everybody could do it, and there'd be no opportunity in it. Mm-hmm. So let me define what I'm talking about a little bit. The very basic formula for investing, everybody says this, but that doesn't mean they really get it, is buy low, sell high. What does that mean, though? If you're going to buy low, you can't buy what everybody else is buying. Everybody thinks it's safe to get on the water. The market is frothy. That's not the time to buy low. You can buy low what nobody else wants to buy. That's what I mean by falling safes and other killer opportunities.
Okay.
You know, if you try to catch a falling safe, the proverbial catch the falling safe, it's going to squash you flat. On the other hand, if you're looking for opportunities that nobody else is willing to do, like catching falling safes, then there are opportunities for buying low, to buy what nobody else wants to buy. So I guess the sneak preview really is, how do you catch a falling safe? Well, obviously you don't stand under it. The way to catch a falling safe is to let it smash and then pick up the pieces.
Makes a whole lot of sense. So Monday afternoon at 4 at the World Resource Investment Conference, we want you to check out Louis James talking about Contrarianism 101. Over at caseyresearch.com, David Gallant, talking about gold's contrarian moment, says it feels a whole lot like the movie Groundhog Day. 1 week it's Greece, then Spain, then France, then the U.S., and then we are back to Greece again. It's just a merry-go-round here.
Yeah, it's it reminds me of that Chinese curse, may you live in interesting times. Mm-hmm. Though actually it turns out, I'm told by my Chinese friends, that that's only half the curse. It's may you live in interesting times and come to the attention of important people. So we don't want to do that, but we certainly live in interesting times. And look at this merry-go-round over there. But you know what? It's funny. During 2008, during the beginning of the crunch year, and actually earlier in 2007 with the trouble in the subprime mortgages and so on, the Europeans were scolding us Americans for being so profligate and having so much debt and bad loans and things. And now, of course, the shoe's on the other foot, and people are scolding the Europeans for having excessive levels of sovereign debt and so on. But the truth is, it's not really their problem or our problem. It's the whole global financial system, which was profoundly influenced by decades of Keynesian thinking, which encourages governments to live beyond their means. And that's true on this continent, it's true on their continent, it's true in Asia. It's a big problem, and the chickens are coming home to roost anywhere in the world.
We are seeing a huge flight to quality from the euro basically to the dollar. And what kind of quality are we looking at here?
Well, we joke about the dollar being like toilet paper, and my colleague Marion Katusa likes to say, well, at least the dollar is three-ply toilet paper. So it's not the sort of quality that I believe in or want to put my future financial security in. It's the least bad option people see at the moment. It's sort of like, I remember back in the election days when Clinton was running for re-election, and the campaign was ABC, anyone but Clinton. That's the strength of the dollar. It's not that people love the dollar, it's that they hate everything else. Yeah. So it's anything but the euro right now. And that shoe also moves from foot to foot. That's not a grounds for confidence. And by the way, it's interesting, when the euro is weak, the dollar seems strong, and gold has a tendency to sell off a bit when that happens. because gold is priced in dollars. So if the dollar seems strong, then the safe haven thing and the pricing in dollars makes gold drop. But that's actually a crazy reason. Actually, that's an opportunity. If the Eurozone is in trouble and gold sells off because of this artificial link and mechanism with the dollar pricing, that's a great opportunity to buy, because think about what's actually happening. The world is becoming a scarier place. The Eurozone is having economic difficulty. So you're going to sell gold? That makes no sense at all. The only reason that happens is because old-style thinking has people selling gold when the dollar goes up. But just that's really a temporary lap in the race to the bottom when one currency or the other is ahead, if you want to think of it as being ahead. We look at those as buying opportunities.
We're talking to Louis James from Casey Research here on This Week in Money. Gold price steady this week, still on track for its worst May performance in 30 years, Lou.
Well, you could look at it that way, or you could look at the long-term trend for gold and say that, look at a 10-year chart and tell me that the bull market is over. Or actually, we're not really chartists here at Casey Research. We do have some friends who do a lot of TA, and they do their thing. But our specialty is fundamental analysis. It's Casey Research. We look at the global economy, we hope, with the realistic and not jingoistic or prejudiced point of view, and try to look at the facts. And the facts are that the system is in serious trouble. And really, everything that governments have done since 2008 has made things worse. Now, temporarily, you can reflate things. You can make the economy look rosier. You can pump fresh blood into a dying body, but that doesn't actually heal the underlying causes. And if we had a debt crisis, then to heal that or to prescribe medicine of that, of more liquidity, encouraging more debt, that really doesn't cure the problem. It doesn't put anybody back on a stable basis of producing more than you consume and creating wealth going forward.
Going to quote David Gallant here again, Lou. David says, gold's correction, nothing to be concerned about when you focus on the mess in Europe and Japan, China, and the U.S. Viewing gold at these levels as anything other than an opportunity is a huge mistake.
I agree. I couldn't have said it better myself.
Yeah. We are talking to Louis James from Casey Research here on This Week in Money. And, of course, holding gold for the long term seems to be a whole lot smarter idea than just trading in and out. Or is the opposite true? What do you think?
Well, here we come to something that Doug Casey has long said, and I think this is a very important point. Whether people think, our recommendations are good or bad, people like my portfolio, my stock picks, whatever, all of that is aside. There's a very important essential point for everybody who's considering this sector, and that is you don't buy gold as a speculation. There is speculative upside to gold. If governments print lots of money, the price of gold is likely to go up. But other costs will go up too. The reason for buying gold is prudence. The reason for buying gold is that it is gold. Ultimately, when push comes to shove, if you've got an ounce of gold in your hand, a physical piece of metal, somebody will take that gold from you in some future point for bread, gasoline, a house, whatever it is that you're transacting. The gold will still be gold. It will still have value. It's the only financial asset that is not simultaneously somebody else's liability. You buy gold for prudence. You buy gold to protect your wealth. To speculate, though, really speculate and try to make money on the moves in the market, that's what the gold stocks are for.
Okay.
In most commodity-related stocks, you see a very clear pattern historically where whatever the move of the underlying commodity is, the related stocks magnify that move. If gold goes down a little bit, the gold stocks get hammered. Gold goes up significantly, the gold stocks soar. There has been some aberration in this pattern in the last year, which we believe creates an actually even better buying opportunity. But the overall pattern of this magnification of the underlying moves in commodities is very strong. And the speculative oomph from participating in the stocks, if you believe gold is going to rise, is terrific. But that is speculation. And you understand when you do that you're risking capital. And that's okay. That's what speculation is all about. You want to try to make some money on the moves in gold? There are fantastic picks available right now in profitable companies that have growth on tap and are likely to produce life-changing, wealth-creating events for shareholders when gold resumes its northward climb. But that's a very different thing from buying gold for prudence.
Louis, for folks who are terrified at the idea of gold stocks, I want to point them to your excellent Kitco interview with Alan Sikora from a couple of weeks back. You said you can't keep ignoring a mining sector that has been mostly profitable.
That's true, and there's two ways to look at that. One is, if things continue as they're going, and if things continue as they're going, these guys are continuing to crank out profits, and the market isn't stupid. Ultimately, people are going to look for sectors that are making money, and that will have its day in the sun. And that will trickle down to the smaller companies as M&A activity continues. Most of the major mining companies, they view the juniors as sort of an outsourced exploration program. It's other people's money, other people's risk. Mm-hmm. The successful junior makes a discovery, and the big guys step in to buy them out. So even on the junior level, this is all very bullish. But that's if things continue as they're going. If they don't continue as they're going, if we at Casey Research are right, that 2008 was really the opening act, and we're in for a lot more economic trouble, you're going to see a lot of unhappy people on Main Street or Wall Street in regular type investment. And when those people are desperately looking for a sector that's profitable, where can we invest that people are actually making money? I think gold will really shine, proverbially and as well as in reality.
Louis, you were talking earlier about buy low, sell high, and you're saying here in the Kitco interview, buy a company when you see value rather than trying to pick a bottom. Nobody knows where the bottom is.
That's correct. I also said if you obsess about looking for the bottom, you're likely only to see it in your rearview mirror.
Got another quote here from our friend David Galland. It says, in this environment, gold is not just a good idea, it's a lifesaver.
I absolutely agree. And again, it comes to that distinction between prudence and speculation. With all the crazy things governments are doing, pouring debt gasoline on the fire of debt problems in the economies, it's the potential for very serious tumult ahead is very real. And it's I buy physical gold, and I don't do it because I'm speculating that gold's going to go up and I'm going to be able to cash in. I do it because I want to have physical gold in my possession, come heck or high water.
One final quote here from David Galland, who is urging us to be cautious about commodities as a whole, at least until we see some signs of inflation showing up in earnest. What do you think is going to happen there?
Well, commodities writ large, that certainly makes sense. If you're bearish or fearful about the economy, of course, that's bearish for commodities prices in general. And the thing to make sure is clear there is that gold and secondarily silver are not regular commodities. Gold isn't something like pork bellies that we eat up and it's gone. Mm-hmm. It is a monetary asset as well, and it's something that you need to think of differently from other commodities.
How do we position ourselves as investors and as speculators going forward from here, Louis?
One size does not fit all.
Yeah.
That's something, I hate to say it, but maybe people should subscribe and read what we have to say on that. We have a lot of words out there on that. But very quickly, I think the place to start, this may sound philosophical, but it's not. This is hard-boiled investment advice. You really have to introspect. You have to know yourself. You have to understand your own risk tolerances. What level of risk is acceptable to you? Are you really focused on the wealth generation end of the spectrum more than the wealth protection end? And that will have a lot to do with how you allocate your assets. But if you don't own physical gold, you want to, and you want it to be physical, the ETFs and so on, those are sort of trading vehicles for gold. If you're going to own gold for prudence, you want to have physical possession of the gold.
Okay.
That's the first starting place. And then as far as speculating on the stocks, like I say, you have to start with understanding your own level of risk tolerance, and then you can think about, you want to stick with the majors, the companies that aren't going away to tomorrow almost no matter what happens, versus how many of the juniors that might have a big discovery that might get bought out and go 10-1. You have to pick and choose depending on your own ability to stomach the volatility.
Louis James is Chief Metals and Mining Strategist, and he's Senior Editor of the International Speculator and Casey Investment Alert. He's online at caseyresearch.com. Don't forget, he's at the World Resource Investment Conference in Vancouver this Sunday and Monday. You can register at cambridgehouse.com. Louis, thanks for this.
Yeah, thank you very much.
After the break, Robert Campbell on This Week in Money.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
It's all about money. At the HowStreet.com Money Expo, they'll be talking money, making money, saving money, and protecting assets. See Ross Clark with technical analysis, Louis James on metals and mining, David Smith on junior markets and more. Plus, visit with industry exhibitors. The HowStreet.com Money Expo in Victoria at the Conference Center, Saturday, June 16th. To attend free, pre-register now at moneyexpo.ca. That's moneyexpo.ca. It's all about money.
This Week in Money is archived online at talkdigitalnetwork.com.
Robert Campbell wrote Timing the Real Estate Market. He publishes the Campbell Real Estate Timing Letter. Hey, the May edition is out, featuring market timing signals for 17 major U.S. cities. You can find Bob online at realestatetiming.com. Bob, it's good to have you back on This Week in Money.
Thanks, Phil. Good to be here.
In the news, Scotiabank Vice President Derek Holt doing a roadshow in U.S. cities this week. He's talking about Canadian housing, why it's different from the States, and the usual stuff. Our diversified economy, household debt is slowing, Canadian dollar is strong, Canada's banks are strongly capitalized, the same stuff we've been hearing before. What do you see from your perspective? What are you looking at with Canadian real estate?
My perspective is very recent, and I saw a chart comparing U.S. housing prices, the bubble that was created, and then the bubble that burst, and comparing and then on that same chart it showed Canadian housing prices. And I know you guys had that one little dip after we had our crash, but you've resumed the upward momentum again, and you're still trending higher and higher. And my first observation is looking at that chart is, being the statistician that I am, I said, you guys are in very thin air, and a correction is coming your way. There's almost zero doubt in my mind, because this is what markets do. You guys are so many standard deviations away from the long-term norm, and that's what happens in asset prices, They eventually come back down. So I'm surprised you guys have stayed up as high as you have, but you have to respect the markets. But I would certainly be, if I was speculating and want to protect my profits in real estate, I wouldn't wander too far away from the exit door, Phil.
Now, this guy, obviously being a bankster, is talking his book, right?
Absolutely.
Yeah. Here's an interesting bank survey just showing you how crazy things are here in Canada from the Royal Bank of Canada. Latest survey shows the average single-family home in Toronto takes almost 3/4 of a family's after-tax income to carry. The same house in Vancouver requires 111% of take-home.
See, I'm an economist, okay? I love reading about past history and stuff. And if you study bubbles and manias that get started, that's the point they get to. They get to the point where they make no sense whatsoever, and then they're going up for the sole reason that prices are going up.
Yeah.
And everybody keeps piling on. But that is a clearly unsustainable condition that the Canadians are with respect to the real estate market. And it's going to correct, and it could correct very, very big. In fact, I would expect it to correct very, very big.
Is the market chasing its tail up here, Bob, do you think?
Yeah, exactly. But see, sometimes, you know what, it's like greed fuels greed, fear fuels fear. Mm-hmm. Okay, that's how markets work. So right now the greed's fueling the greed, and that works, but you just have to know when to get off.
Now, based on your experience over the years in the U.S. market, what kind of advice can you give to Canadians who own houses?
It would be to be tracking markets very, very closely. Okay, and they've got such enormous gains in them right now. Unless you're a rich individual that can, that you've got all the money that you need, and you don't need, and most of it's not in the equity in your house, which most people it is. When it's at the peak, I would sell that property, get out, preserve capital, and then protect your capital, and then get out, rent for a while, and buy a less expensive home 2 or 3 or 4 years down the road, whatever the case may be with respect to the trends.
Bob, we're going to get the standard complaint here that renting is throwing your money away. How do you answer that?
Well, one way to answer that here in the United States, and that's a great question, interest rates are so low right now. In the average U.S. city, for example, you can buy a house, you can own a house for 14% less than you'd have to pay for renting the damn thing. So, I mean, there's economic reasons for doing that, too, especially here in some places. So, with respect to the U.S. market, rents are just keep going up at 2 or 3 or 4% a year. Interest rates are just crashing like they are right now. Pretty soon, 30-year fixed mortgage rates are in the 3 3.75, and I wouldn't be surprised if they dropped to 3.5 after this weekend, somewhere down in that range. It's incredibly inexpensive. Money's incredibly inexpensive, and it's cheaper to buy right now than it is rent, assuming you can qualify for a loan. And not everybody had their old home foreclosed on, so there are qualified people out there.
We're talking to Robert Campbell from the Campbell Real Estate Timing Letter here on This Week in Money. And speaking of mortgage rates being low, Wall Street Journal reporting today, 30-year fixed mortgage rate at an all-time low. And I guess that's based on, because it's based on the 10-year Treasury. They're also trading at an all-time low.
Right.
What's your take on that? What do you think?
Interest rates are going to keep going down lower and lower, Phil. Now that the U.S. economy, their GDP figures are being revised lower. You saw today's job report. We created 69,000 jobs. Last month was revised downward from 115 down to like 73.
Wow.
It's dismal. GDP is falling. The economic numbers are weak. And with all the debt in the system, the U.S. government and the Federal Reserve cannot allow interest rates to rise. So they have no choice but to continue to quantitative ease until we have a high level of inflation, and which will eventually, screw the bond market. And that's what eventually crashed the system.
Bob, let's move on to the U.S. market. New information from the Case-Shiller folks. The index falling to new lows. Housing prices back to levels where they were in late 2002. Are you seeing prices starting to stabilize a little down there?
Yeah, in the 17 cities I follow, I think last month's issue showed that 10 were in uptrends and only 7 were in downtrends. And a year ago prior to that, Phil, it was only four cities in uptrends and 13 in downtrends. So prices have fallen so far here in the United States that finally we're starting to get to a stable point. And some key indicators I follow, and especially that rent-to-income indicator, that clearly shows that we are at or near a bottom right now. And if you can buy cheaper than you can rent, and you can get tax write-offs to boot, and cut your cost of living down, that's why I gave the all clear for people. Why not? You got to live somewhere, Phil.
Yeah, you're mentioning the ratio of prices to rents. Coming back to earth, this is the report from Deutsche Bank, and help me out on this. It says the average rent is now 15% more than the average home loan payment. How does that work?
What they're doing is they're looking at different cities throughout the United States, and knowing what the average price home is, and then looking at it and saying, if you put 20% down on a home and you could qualify for that mortgage, what would that mortgage payment be relative to, the average rent in the area? So even though it's not a comprehensive, doesn't embrace all the costs of home ownership, it's a key indicator to watch those trends. And this is the first time in about 30 years, Phil, that it's been where that indicator has fallen not only below where the lines have crossed, but it's crossed by a significant number, 15%. So at some point you got to do something. Mm-hmm. And I'm saying, like here in the States, you got to live somewhere, right? And if you can afford a home and you can cut your cost of living, and renting sucks, it does suck. But if you can, own cheaper than you can rent, why not?
If you could own a place or rent a place, where would you do that?
Well, there's certain cities. I'll tell you the two best cities to do it in right now is where things have fallen the most here in the United States would be Las Vegas and Phoenix. Those property values crashed there like 65%, and the incomes didn't fall 65%. So now incomes are really high relative to the old, the old standards with against property values, and that's why you're going to see, that's why we're currently seeing a resurgence of activity, especially in the low end properties. But everything hits a bottom. Everything hits a bottom at some point in time. And any time that you can, use the numbers to your advantage, which I think you can do with owner-occupied homes. But here's what I still advise people to do on an investment standpoint: don't have more than 1/3 of your money in real estate, Phil. Mm-hmm. I mean, I'm all for buying a home. If you can buy it cheaper than you can rent, absolutely. But still, don't load up the train on real estate. I'd rather have other investments too.
Now, you're mentioning about 1/3, and here in Canada, the ratio is almost double that.
Oh, absolutely. Yeah. Most people are way overweighted with respect to real estate to where their net worth is. And this is what's going to be the problem with boomers here, because this is where their whole net worth is,
yeah.
Phil. And they're going to have to free up that capital to somehow try to use it to gain a return just in order to survive.
More with Robert Campbell next on This Week in Money.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com, or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
We are back with Robert Campbell from the Campbell Real Estate Timing Letter. Always good to have a look at the National Association of Realtors website, Bob. We always get some good comedy material from there. And they're talking about housing markets in the future. We're talking about boomers. They're saying it depends largely on the children of the boomers, the echo boomers.
I know. So, you know what? Look, I don't believe a word they say. I've never believed a word they say. And so, but, the fact that most people, I believe about 95% of what you read and hear is BS anyway, Phil. I mean, where the brains come is being able to separate out the people you should listen to and the data you should follow, and not that you should ignore.
Yeah.
That's where the success comes in, and then act on that information, and you make money in the markets and you don't lose it.
Here's National Association of Realtors Chief Economist Lawrence Yun saying demography is destiny.
It is destiny, but I think the destiny is on the side of destiny follows supply and demand, and there's a heck of a lot larger supply of older people that are retiring and going to be trading down than there are the younger people, their offspring, that are coming up, and that's the cause of the problem. That's the cause of Social Security too.
Bob, we were talking just off the air before the broadcast about boomers who are house rich and cash poor. This is going to be a problem in the States as well as in Canada, right?
Oh, absolutely. It's a problem in Japan. The whole world is aging, Phil. You go to Europe, Japan's got a worse problem, but most people have the majority of their net worth in their house. And your house doesn't generate an income for you. And in many instances here in the United States, they own more house than they should, than they can really afford. And that's what's going to cause cause them to trade down. See, I don't need a 2,800 square foot house. I could live just as nicely, me and the wife, in a 1,200 square foot house, right?
Mm-hmm. Yes.
Less energy, less expense, less maintenance, less property tax. In other words, you're just cutting your cost of living. And you're not doing that because you don't need the money. You're doing it because you do need it.
Got another little nugget here, Bob, from our pals at the National Association of Realtors, talking about distressed property. They're saying the numbers are falling over the last couple of years, and that's another reason for higher home prices going forward. What's your take on that?
Well, when you say distressed properties, it's all how you measure that.
Yeah.
There's different degrees of distressed properties. Are defaults coming down? Absolutely. Are they still, mortgage defaults? Yes. But are they, or I should say, loan delinquencies? Are they falling? Yes, they are. Yeah, but they're still elevated about 50% above the long-term norm. So we still have a lot of default, a lot of mortgage delinquencies to go before we get back to normal. And here's one of the big kickers. It's this massive and somewhat unknown level of shadow inventory that's out there. And it's anywhere between 8 and 10 million homes. Now, who controls this? The banks. Okay. that the banks are, run the show anyway. Look, if they want to, they don't have to let this stuff go out. They don't have to follow rules and get it off their books anymore. So, but if they ever, have a come to Jesus moment where they have to get rid of this stuff, I mean, that's going to put terrible downward pressure on the property market. But, as long as they can just keep it off the market, hold it off the market, and, the U.S. government can finance its deficits with newly created money, what the hell, huh?
Robert Campbell from the Campbell Real Estate Timing Letter here with us on This Week in Money. In other news, we've got news from the Wall Street Journal, a mainstream of the mainstream, talking about home prices falling 0.03% in March. And after adjusting for seasonal factors, they rose 0.09. A lot of zeros in here. That's according to the Case Shiller. That's barely moving the needle, isn't it?
Yeah, it's barely moving the needle. But see, there's an interesting aspect to that. It's called momentum. What we're finding right now is even though prices on a year-to-year basis, which is the best way to look at them, are still down, the downward momentum, as each month goes by, the year-to-year price declines get smaller and smaller. In other words, that's showing upward momentum off of a bottom, Phil. So we're getting pretty damn close to a bottom here.
All
now,
right.
Look, if the U.S. goes into a here's the proverbial wild cards. Is the U.S. economy getting stronger or weaker? Weaker. Do I think that we have a chance of going into recession? Yes. Probably, 75% chance of going into recession. How about the shadow inventory? But, the market is so manipulated right now with respect to supply and demand on the real estate side. What's really keeping the real estate market here, above board are these incredibly low interest rates, and those are totally faked up by the Federal Reserve Board, that, buying the market, buying all the debt. So I think we definitely have risks, but I think there is some opportunity, relative to doing nothing, like buying a home in the right city right now at these incredible low interest rates. I don't think you're going to get too badly hurt, and in a worst case situation, you're going to own your own home and not have to be subject to a property owner telling you to leave or raising the rent on you.
Hey, Bob, tell us how we can subscribe to the Campbell Real Estate Timing Letter.
You can go to my website, and it's at realestatetiming.com, and there's a link you can click on up there called Real Estate Timing Letters, and you can read some past issues, and look at everything I have to say. And if so, you just print that out and send me a check, and that you can be updated on, with the kind of information you're hearing here on a regular basis through my timing letter, which is once every 2 months.
Robert Campbell, always fun to talk real estate, my friend. Thank you.
Thank you, Phil. Bye.
Thanks to our guests, David Morgan, Louis James, and Robert Campbell. And thanks to you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.